In 1998, a hedge fund called Long-Term Capital Management collapsed. Despite a leadership team featuring Nobel Prize-winning economists, their sophisticated models failed to account for a simple human reality. They had borrowed $25 for every $1 of their own capital. This extreme leverage converted a minor market fluctuation into an existential crisis, forcing the Federal Reserve to coordinate an emergency bailout to protect the global financial system. If financial success were a pure calculation, these economists would be the wealthiest people on Earth. Instead, they proved that the most brilliant minds can still make the most expensive mistakes. Warren Buffett has spent 80 years watching these patterns. He argues that invisible behavioral errors destroy more wealth than any market crash or economic disaster. The stock market acts as a filter for temperament, frequently rewarding emotional discipline while penalizing raw intelligence. During market bubbles, euphoria replaces analysis. When stock prices climb daily, investors often mistake a rising tide for their own financial brilliance, convinced they have suddenly developed elite trading skills. To defend against this, Buffett uses a boundary called the circle of competence. The inner circle contains the specific industries and business models you genuinely understand. Everything else stays outside. Ego tempts investors to cross this line. When you invest in a business you can't explain, simply because it looks profitable, you have stopped investing and started gambling. Many investors hide this lack of understanding through over-diversification. Owning 50 or 60 stocks, most of which you've barely researched, functions as a psychological shield to mask a lack of true conviction. Real risk management comes from concentrating capital on a few businesses you understand deeply. Spreading money across dozens of unknown assets is a confession you don't trust your own analysis. Wall Street functions as a center for emotional contagion. Headlines and rumors trigger mass reactions, pulling the crowd into a cycle of fear and greed. This chart highlights the difference between price and value. The erratic line is the price, which reflects the mood of the crowd. The steady line is the value, the actual earning power and economic strength of the business. Successful investors demand a margin of safety. They buy only when the crowd's mood pushes the price significantly lower than the business's actual value, creating a buffer against future errors. In 1963, a fraud involving non-existent salad oil caused American Express stock to plummet. The crowd fled, fearing catastrophe. However, a look at the actual business showed that customers were still using their carts and the brand remained intact. Buying during that panic generated massive returns. Wealth is built in uncomfortable moments, when rational analysis directly contradicts the terror of the crowd. Investors saving for a 30-year retirement often make reactionary decisions based on what happened this morning. They try timing the market, reacting to daily news as if it impacts their long-term goals. This curve represents the mathematical reality of compounding. The most significant gains are backloaded, occurring almost entirely in the later years of an investment. The first decade of holding an asset provides the foundation. The remarkable, life-changing wealth only arrives in decades 2 and 3, provided the investor does nothing. Most people never see these gains. They dig up their seeds to check the roots, selling off great businesses because of a single quarterly earnings miss or a temporary price drop. The market serves as a mechanism that transfers money from the hyperactive and impatient to those with the discipline to wait. Behavioral mistakes usually begin when an investor views a stock as a flickering digit on a screen. When you focus on those red and green lines, you are reacting to symbols rather than substance. Lasting success requires a different habit, viewing every stock purchase as the acquisition of a piece of a physical, breathing economic engine. You are buying the factories, the customers, and the cash flows of a real-world entity. When Buffett bought See's Candies, he ignored the stock charts and focused on brand loyalty. He saw a business with the power to raise prices because customers wouldn't accept a substitute. That physical reality earned billions, regardless of market volatility. Individual investors possess a structural advantage over large institutions. You are not forced to report quarterly results or follow a benchmark. You have the freedom to sit still and do absolutely nothing. Mastering the market requires the humility to acknowledge your psychological flaws, the discipline to stand alone, and the character to outweigh the crowd.